Hi friends, markets are hitting all-time high. Nifty has topped 26,000 and Sensex has crossed 85,000. Three hypercritical questions right now. Question number one is, are we in a stock market bubble right now? Number two, will this bubble get busted and are we likely to see a correction or a crash in the upcoming weeks and months? And number three, more importantly, how should we prepare in such a market situation when market has hit all-time high? In this video, I'll give you data-backed analysis, and if you like the analysis, hit the like button and be part of my YouTube community. With that, people who don't know me, my name is Rahul Jain. I'm a full-time investor and a content creator. With that, let's try to answer the first question, which is the stock market right now in the bubble or not? So the first key data point is that the promoters in the last 3 months, Q2 of 2024, they have been selling their stakes and they have offloaded worth 40,000 crores of their own stakes. Now, if you look at the history, you will notice that in 2021, promoters totally sold 54,000 crores of stakes. In 2022, it came down to 25,000 crores because in 2022, we had a correction in the stock market. Therefore, promoters will not sell their stakes when the market moves are not at the high levels, right? In 2023, if you see, the promoters totally sold 48,000 crores, and then comes 2024. So far, up to the month of September, total 1 lakh crores of stakes have been sold by promoters. There are still 3 more months to go, and I do not know whether this selling will continue or not. But the point here is that promoters will sell their stakes when they know that they are getting a very good value of their stakes, because please remember, promoters put their sweat and blood into the company, and when they see that the market is rating their company at a very high level, then possibly its intrinsic value, what are they likely to do? They're likely to join the party of profit booking, and hence they have diluted their own stakes. So out of these 180 companies, here are the top 10 companies where the promoters have done a lot of selling in terms of the total deal size. So from this data point, we can conclude one point, that there are some pockets in the stock market where the valuations are crazy. It doesn't mean that the entire market is in a bubble or valuations are crazy everywhere. That's not the case. Out of more than 5,000 listed companies, we can see that these 180 companies promoters have sold their stakes, meaning that there are pockets where the valuations are really crazy. Data point number 2 is, have a look at my screen and you will see that buy calls in the Indian stock market right now are diminishing. What is a buy call? Let me quickly explain to you. Let's say there is a stock XYZ and it is covered by, let's say, 20 analysts. Now, out of these 20 analysts, if majority of them have a consensus buy that there is a buy rating on this stock, then we say that majority of the market treats this stock as a good opportunity to accumulate or buy or take a fresh entry into this stock. And right now, if you look at the Nifty 200 companies, the top 200 companies, have a look at this data, you will see that in the last 5 years, out of 200 companies, generally you will see a buy call or a consensus call in more than 100 companies. But right now, as of September 2024, there are only 61 stocks out of the 200 stocks where there is a consensus buy rating on a particular stock. And interestingly, see the hold proportion here. It used to be in 2022, for example, 86. In 2023, 77 companies. Right now in September 2024, there is a hold consensus on 129 stocks. Seems to me that right now more and more stocks are into the hold category. It doesn't mean that you go and sell away everything. In fact, the sell rating is not gone very high. There are only 6 stocks where the consensus buy is saying that sell these stocks. So the point here is that there are very limited opportunities right now in the Indian stock market where you would go and take fresh entry or where there are consensus buying among the analysts. So the key takeaway here is that the large proportion of the Indian stock market right now, which is 129 companies out of the 200 companies, there is a hold rating right now. So it makes sense that when we do any fresh buying right now in the Indian stock market, we are really careful. And that is because right now finding good buy opportunities right now in Indian stock market are very limited. And this is where the deep analysis come into handy. Whenever you're planning to buy any stock, I would highly recommend, before you buy any stocks right now, please do a thorough analysis. I'm almost on a daily basis posting a lot of deep analysis on my YouTube member community, and if you want to get benefited, go to my channel and press on the join button. You are going to learn a lot in this community. The feedback has been excellent, so you are going to enjoy this community. With that, let's move to data point number 3, which is mutual funds are sitting at an all-time high cash as of August 2024. It is coming out to be 1.86 lakh crores. This is a huge money. And if you look at this data by AMCs, you will very quickly note that the Quant mutual fund is sitting at almost 19% of the cash, while Parag Parikh is sitting at 16%. But remaining other AMCs, you see there is not huge cash they are sitting on. Now, just because mutual fund houses are sitting on huge cash, it doesn't mean that the market is going to correct or crash. It does simply mean that they are finding it hard to spot good buy opportunities that can give them good returns. And our point number 2 and point number 3 sort of complement each other. We can join it together and say that yes, right now in the Indian stock market, the buy opportunities are limited. So therefore, if you're trying to take fresh entries, you really need to be convinced that the stock that you're buying is a very, very good buy, maybe in the medium term or long term. So looking at these 3 data points, I can continue to present a lot of data, but the point that I want to drive home now is that in Indian stock market right now, there are pockets which are highly overvalued. Therefore, we need to be really conscious about where we are taking the buying opportunities or not. Let me now help you understand these pockets in terms of the market cap. So we are going to look at the large cap, mid cap and small cap, and let me present you some data there. Now here is some interesting analysis for you. If we look at the large cap space right now, the P right now for Nifty 50 is at around 24.34. The 5-year average of Nifty PE has been 25.28. So right now we are trading slightly below than the average PE of Nifty 50 in the last 5 years. Now it's not that the PE ratio of Nifty 50 is hitting all-time high of 42, 41, 40. So what we can see here that the earnings that these companies have and the price at which they are trading, there is not a massive imbalance in my view. But if you look at the PB ratio as well, and you will very quickly see that the current PB for Nifty 50 companies put together is 3.87. 5-year average has been in fact 3.94. So again, from a book value perspective, I don't think large cap space is highly overvalued at all. In fact, this is fairly valued. I don't think there is any bubble right now in the large cap space. So if you're looking for good buys right now, fresh entries, I think large cap space is the one where you go and select some quality stocks for your investment. Not an investment advice or stock recommendations here, but this is what the data is telling us, that the large cap is looking very, very good right now. If you look at the Nifty mid cap 150, which is stock number 101 to 250, where very quickly you will see that the current PE ratio is 45.13, while the 5-year average has been around 28.99. So from an earnings perspective, mid cap space is highly overvalued in my view, and there is a bubble right now in the mid cap space. If I also look at the PB value, you will see that the current PB is 5.36. The average in the last 5 years have been 3.92. From that perspective also, mid cap space looks very, very overvalued to me right now. What about small cap space, Rahul? Have a look at my screen. You will see Nifty small cap 250 PE ratio right now is 31.76. 5 years average has been around 23.64. It is slightly overvalued, relatively less overvalued than mid cap, but from a large cap perspective, it is slightly overvalued. If you look at the PB ratio of Nifty small cap 250, you will see that the current PB is 4.25, while the 5-year average has been 3.51. So we can clearly see that there is some froth building in small cap as well. But if I look at all these three, my key takeaway here is that the mid cap space is highly, highly overvalued right now. And that is why precisely I had sold my mid cap ETF just few days back. I had posted the same rationale on my YouTube member community. And to be honest, I'm not saying that the mid cap will not continue to grow from here on. The point I'm trying to make right now is that the valuation wise, I don't like mid cap space right now, because I've seen the PE ratio and PB ratio is hitting all-time high. And if there is a correction, I'm not saying again the correction will happen. All I'm saying is that if there is any correction, then mid cap stocks might correct slightly more than large cap or small cap. Therefore, it is better for me to cut my positions in mid cap, and that's what I shared on my YouTube member community. And this is the sort of analysis I share on my YouTube member community. If you're not yet a member, join my YouTube member community. You are going to learn a lot with these practically data-based analysis. With that, let's move to point number 2, that Rahul, given the current market situation, are we likely to see a correction or crash in the upcoming weeks or months? The simple answer is that I do not know. I am not an astrologer and I do not speculate on whether the market will correct or not in the short term. My point is very, very simple, that I am a long-term investor. I remain invested for long term, and I know I am bullish on Indian stock market from a long-term perspective, because I can see that the earnings growth that the companies have in India is huge. As you can see that Nifty 500 companies in 2024 grew by 30% year on year, which is a massive growth. So from a long-term perspective, I remain bullish, and I'm not going to speculate whether the markets will fall tomorrow, next week, next month. They may fall, they may not fall. Markets sometimes need some sort of triggers to be able to come down and then rally back further. So in short term, I'm not worried at all. But as an investor, my job is to always prepare for market corrections, market ups and downs, and that is the approach I am going to discuss with you now. Now comes the $1,000,000 question, that how do we prepare for market correction if at all it happens, right? Now for that, what I've heard is various views, that there are people who say that you have to build a 5% liquid assets in your portfolio. Some people are saying that actually you need to build 30% of liquid assets and just make sure that you're only invested by 70%, so that whenever the correction happens, you can use the 30% to buy the dip, right? So there are various viewpoints, but in my view, it really depends on your portfolio, whether you want to hold 5% cash, 10%, 20%, 30%. And let me tell you what will drive that exact amount of cash that you should be holding in my view. So for example, I am going to take, let's say you have a portfolio of, let us assume that you have in your portfolio total 20 stocks, right? Let's say your total portfolio size is 10 lakh rupees and you have total 20 stocks in it. Out of these 20 stocks, let us assume that 12 stocks that you have are long-term bets, right? Remaining 8 stocks might be different. I'll come to that in a minute, but let's say these 12 stocks are long-term bets. So what you need to do is please remain invested in these long-term stocks, because no matter what happens to market conditions, you have a reason for you to be invested, which is that in a long term you are going to gain and these stocks are likely to compound, right? Now comes the question that what happens if the market corrects? So let's assume that the Nifty drops by 5% in a week's time, and these 12 stocks that are your portfolio, let's say they drop by around 15%, right? Now, this could be a very good buying on dip opportunity for you, and you don't want to miss out on it, because 15% correction on your long-term portfolio is a very, very good buy on dip opportunity, right? I'm not saying that it will fall by 15%. I'm just taking some examples for you to understand the right mechanics behind it, right? And buying this dip is really, really important, because let's say these 12 stocks are growing like this right now, and all of a sudden there is a fall here, and this might consolidate here, but in the long term they are going to recover and they are going to make some good profits for you. Therefore, you don't want to miss out on this particular dip. And let's say that right now, if the market falls, you get 15% of dip in your 12 stocks that you have as a long-term portfolio. First point is that do not get panic, remain invested, but you need cash for you to be able to do buy on dip on these 12 stocks, right? And how much of this cash should be? For this, what you need to do is have a look at your portfolio, stock number 1, 2, 3, 4, 5, right up to 12 stocks, and ask yourself how much more money you want to put in each of these stocks if they fall to a particular price level that you are willing to buy the dip, right? Again, it is going to be your individual call, right? Let's say stock number 1, you want to put 5K. Stock number 2, you want to put 10K. And so on. And you might come to a position wherein you will say that, Rahul, in these 12 stocks, if there is a dip, I am going to put another 2 lakhs rupees of total money. And this 2 lakh out of your 10 lakhs of total portfolio is going to be 20%. So for you, 20% of cash is what you need. And what you need to do is have a look at your earnings, and you see that if you have 20% cash, then you don't need to do anything about your portfolio. But if you don't have this cash, this is the cash. When I say cash, I mean the liquid assets, right? It could be either into FDs or a liquid ETF or a liquid mutual fund, so that you can quickly encash it and put it back into stock market, right? So this number could be very, very different for everybody, but this is how you go ahead and analyze your stocks and come at the cash number that you want to hold at. Now let's say that you don't have 2 lakh rupees of cash with you out of the 10 lakhs of portfolio. What you really need to do is look at these 8 stocks, right? Now there will be mix of stocks in here. You might have, for example, stocks that you've taken for swing trade, right? You might have some sort of short-term bets here, right? You might have picked up some opportunistic bets here as well, right? So you might have various things going on in these 8 stocks. In these 8 stocks, what you really need to do is find out the overvalued stocks, right? Look at the simple PE ratio. I've spoken about PE ratio, PB ratio, PEG ratio. These are very good indicators to tell you whether a stock is overvalued or not. And if you think that there is no particular reason for a stock to be overvalued, then you need to look at either profit booking if you're sitting on profit, right? Or you need to book your loss and exit the stock, because ultimately what you need to do is build a cash position that you can buy the dip for your long-term stocks. This is more important than your short-term bets in my view, and this is how you go about finding out whether you want to have the cash position which is right for your portfolio or not. So this is the approach that I am personally taking for my portfolio. Please do not take that as a recommendation as such, but this viewpoint will help you make your own decisions. I hope you enjoyed this video. If you did, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, I'll see you in my next video. Until then, keep rocking.